Throughout this course, we've learned how to record transactions, prepare adjusting entries, and create financial statements. But preparing the financial statements is only part of the story. They also need to be organized in a way that makes them meaningful and useful to the people who rely on them. That's where classified financial statements come in. By grouping similar accounts together, businesses make it easier for managers, investors, lenders, and other users to evaluate a company's liquidity, profitability, and overall financial health. In fact, two companies with the same net income can appear very different once their financial statements are properly classified. In this video, you'll learn how classified financial statements are organized, why the classifications matter, and how they help users make better business decisions. You might be asking yourself how the classified financial statements are different from the financial statements we've worked with previously. On the income statement, classification means using the multi-step format, and rather than listing revenues and expenses together, the multi-step statement separates core and non-core operating items, organizes them into categories, and calculates important subtotals like gross profit and operating income. On the balance sheet, instead of simply listing assets and liabilities, we separate current assets from long-term assets and current liabilities from long-term liabilities. This organization makes it much easier to evaluate a company's liquidity and overall financial position. Although both financial statements become more detailed, they serve the same purpose as before. The classifications simply provide additional information that helps users better understand a company's financial performance and financial health, and allow the users of financial statements to calculate important ratios. These ratios are an important tool to compare period-over-period performance and contrast changes in the financial statements to those of other companies in the same industry. The starting point for the preparation of the financial statements in a manual accounting environment is the worksheet. And here's an excerpt of the worksheet for Whiteside Antiques, the example our textbook uses. The worksheet is the bridge between the accounting and the financial reporting. Once adjustments are complete, the worksheet becomes the source for every financial statement. Errors made here flow through all statements, which is why accountants who work in a manual accounting environment rely heavily on this step before classification begins. In practice, though, when you're working for a company, you would likely use accounting software to record adjustments and print out or export an adjusted trial balance and financial statements. However, in this class, you are learning the manual process for accounting, and we'll use the worksheet because it teaches you what the accounting software will do for you in the future. We'll start with a multi-step or classified income statement. First, a classified income statement separates operating activities from non-operating ones. This allows the users to see whether profits come from core business operations or from one-time or non-core business events. That's important because investors want to be sure that core operations are generating the profits rather than non-core or one-off items. The classified income statement starts with the operating revenue section, and in this section of the financial statements, we enter the revenue earned from normal or core business activities, less any sales returns and allowances, which is $549,150 for Whiteside Antiques. For a service business, operating revenue would be the service revenue that the company earns from providing services. A merchandising company would report as operating revenue the revenue it earns from selling merchandise. Just a side note, other income related to non-core or one-time events is shown separately near the bottom of the financial statement. Examples of other income include income from interest, rent, and gains resulting from the sale of fixed assets. The classified income statement continues with the cost of goods sold section, which only applies to merchandising and manufacturing companies. We start the cost of goods sold section with the beginning inventory of $52,000 at the net delivered cost of purchases of $325,120 and subtract the ending inventory of $47,000 to arrive at cost of goods sold of $330,120. After subtracting cost of goods sold from sales, we arrive at gross profit on sales of $219,030. And gross profit becomes a key amount that helps analysts understand the company's pricing and costs. Investors and analysts typically calculate the gross profit percentage, which for Whiteside Antiques is 40%, which is $219,030 divided by $549,150. This represents the markup of the merchandise. Put another way, for every 60 cents the company spends on merchandise, it generates $1 in sales. Or said in a different way, every sales dollar results in 40 cents of gross profit, which must be large enough to cover all other operating expenses and leave profit for the owners. So this is an important number, especially considering that your suppliers could increase the cost of the merchandise. Some industries have a very high gross profit margin, like for instance the software industry. Intuit, the maker of TurboTax and QuickBooks, has a margin of over 75%. Some industries like grocery stores and automobiles have typically very small margins. For instance, Costco has a gross profit percentage of about 13%. Which brings us to the next section, operating expenses, which are typically grouped into selling and general and administrative expenses, often called SG&A. These costs help generate revenue, but they do not directly create products. Tracking SG&A trends helps managers identify inefficiencies and cost creep. Looking at only 1 year, though, is not always helpful, and many businesses tend to compare year over year and quarter over quarter expenses to understand what is happening to the business from an expense perspective. Whiteside Antiques spends about 30% of revenue and 77% of its gross profit on SG&A expenses. That is significant. And looking at some of the expenses, for instance, tells us that the salespeople cost nearly $80,000 in salaries, plus payroll taxes and benefits. But each $1 in sales salaries generates less than $7 in revenue. It's difficult to tell whether that is good without having something to compare it to, like a prior year for this company, or a company in the same industry where the financial statements are publicly available. Analysts definitely look closely at SG&A expense ratios because the expectation is that typically wages and other costs increase every year, but also that the company becomes more efficient. Now, Costco, for instance, I mentioned has a very small gross profit percentage of about 13%, and its SG&A expenses make up about 9% of revenue. And compared to the prior year, Costco's SG&A expenses increased by nearly 9.5%. That's important information. Net income from operations reflects the profit from normal or core business activities after subtracting the SG&A from the gross profit. Investors will want to know whether core functions are profitable and, as a percentage, how much is left from all sales dollars once all expenses are paid. For this business, we calculate that net income from operations is 9.3% of revenue. In addition, investors will want to know if the company operates the business efficiently, by calculating as a percentage how much the business spends on operating expenses. For this business, we divide the operating expenses of $167,833.80 by the sales of $549,150, which is 30.6%, 17% for selling expenses, and about 13% for general and administrative expenses. We don't really know whether 13% is high or low unless we compare the financials for this period to a prior year, the forecast for this year, or to another company in the same industry. After adding other income and subtracting other expenses, we arrive at net income. For Whiteside Antiques, other income and other expenses are very small. But watch out for financials where non-core income and expenses are significant. You will want to understand why these non-core amounts are so large. Companies often provide condensed income statements when applying for credit or sharing information externally. These statements provide enough information to assess performance without revealing detailed cost structures. It is common for companies to provide financial statements, especially if they're applying for credit terms with vendors. That means that you must provide financial information about your company, but do not want to disclose all the details, such as how much rent the company pays, how much you pay in salaries, for instance. You might be disclosing more than you want to. You don't want to give an outsider the roadmap for running your business. In those cases, it might be enough to provide condensed income statements. Condensed income statement provides the minimum necessary information, but not more than that. In this case, the net sales, cost of goods sold, selling and general and administrative expense totals, and then net income from operations, other expenses or income, and finally, net income for the year. The statement of owner's equity explains why the owner's equity changed during the period, and it is unchanged from the statements we've reviewed in prior chapters. It shows the beginning capital and ending capital, and the difference is the net income that increased the capital because the profits and losses belong to the owner of the business. Withdrawals decrease the owner's capital. The statement of owner's equity also shows how good of an investment the owner made by starting this business. For sole proprietorships and partnerships, this statement is especially important. The next step after preparing our classified income statement and the statement of owner's equity is to prepare the classified balance sheet. Just like we grouped our income statement by categories, cost of goods sold, selling and operating expenses, we group categories of assets and liabilities. Assets are classified based on how quickly they can be converted into cash. Listing current assets in order of liquidity allows users to assess short-term financial flexibility at a glance. Current assets consist of cash and items that will not only be converted into cash within 1 year, and items that will be used up within 1 year. Current assets, which are $98,716 for Whiteside Antiques, are vital to the survival of a business because they provide the funds needed to pay bills and meet expenses. Non-current assets or long-term assets consist of plant and equipment. For Whiteside Antiques, they are $31,900. Companies also often use a category called other assets, where the company lists assets that don't fit into the other categories. Whiteside Antiques does not have any other assets, which means that current and long-term assets combined equal $130,616. Liabilities are grouped by when they must be paid. This classification helps users understand solvency and short-term risk. A company with strong assets but overwhelming current liabilities may still face cash flow trouble. Current liabilities are the debts that must be paid within 1 year. They're usually listed in order of priority of payment. Management must ensure that funds are available to pay current liabilities when they become due in order to maintain the firm's good credit reputation. Whiteside Antiques has $46,036.80 in current liabilities. Long-term liabilities are debts of the business that are due more than 1 year in the future. Although repayment of long-term liabilities might not be due for several years, management must make sure that periodic interest is paid promptly. Long-term liabilities include mortgages, notes payable, and loans payable. Whiteside Antiques has no long-term liabilities. The next section of the balance sheet is owner's equity of $84,579.20 for Whiteside Antiques, which combined with its liabilities equals $130,616. Once statements are classified, ratios become meaningful. Classification of the financial statement information helps us compare similar categories across companies and time periods. Each ratio answers a specific question: profitability, ability to pay bills, reliance on debt, or operational efficiency. Congratulations, you've reached the end of this Introduction to Accounting course. Over the past several weeks, you've learned how businesses record transactions, adjust accounts, prepare financial statements, and communicate financial information to decision makers. Classified financial statements bring all of these concepts together by organizing financial information in a way that makes it easier to understand, analyze, and use. Whether you continue your studies in accounting, finance, business, or another field, the concepts you've learned in this course will help you better understand how businesses measure performance, manage resources, and make informed decisions. I hope this course has given you a strong foundation in accounting and an appreciation for the important role accountants play in every organization.